Okay, student, today we're going to do the statement of financial position. According to the question paper, we are required to calculate the adjusted net profit and then to prepare the statement of financial position. So we're going to do 2.1, how to adjust to calculate the adjusted net profit. So on the trial balance, we're given the trial balance of MG Suppliers as at 28 February 2016. Item number last. They gave us the profit before adjustment that have been taken into account, 86880. So we have to take into account the following adjustment and then calculate the net profit, the adjusted one. So we're going to start our 2.1 as putting our net profit before adjustment as 86880. So transaction number 1, now we're taking into account the adjustment. They saying it was found that 18,000 paid for the purchases of the motor van had been debited to the motor vehicle expense account. A motor vehicle expense account is the expense account of motor vehicle, meaning that every depreciation will record them there. So the moment they debited this amount of motor vehicle under motor vehicle expense account, they decreases the profit. When expenses increases, the profit decreases. So by debiting this amount, profit went down. Now we have to correct the error and bring back the amount as what? Motor vehicle expense account as a positive amount. Then statement says it is the company's policy to depreciate motor vans at 28%, 25%, I mean to say straight line basis with the full year charge in the year of acquisition. Whenever we bought it, full year charge. Then transaction number 2, a new laptop was bought on the 28th February 2016. This is our financial year and we can check here, prepare the statement of financial position at 28th February 2016. So this vehicle was bought at a year end for cash 10,000. We won't calculate depreciation on this one. Then the business depreciate equipment at 20% per annum, termination balance method. So now we can account for depreciation for both these assets. So we can start with depreciation on vehicle, the one that was debited on expense account. Here is the calculations. We're going to take our 18,000 multiplied by the 25% of the depreciation, it's 4.5. Then we subtract it from the profit. The rate is here 25%. Then we do depreciation on equipment. This is depreciation on equipment. 100,000 minus 35,000 is equals to 65. 65 by 20% is 13,000. Where does this amount come from? From the trial balance. Our cost price of the equipment is 100,000. Our accumulated depreciation is 35,000. And the method says this depreciation in equipment 20% per annum on termination balance method. So the 13,000 is subtracted against the profit. Then we go to another one. Transaction number 4. The provision for credit losses must decrease with 450. Provision for credit losses must decrease with 450. Whatever that we given must go to 450. So we are given provision for credit losses as 3.3. So it must go down by 450. Must decrease by 450. So a decrease, I told you, is an income. So 450 is an income. We're going to add a 450 as an income. Then transaction number 5. Interest on overdraft for February 2016, 170. 170. Each one has not been entered. Yeah, interest on overdraft for February 2016 has not been entered. Therefore, interest on overdraft, we're going to less it. Then here it is our net profit for the year. Net profit for the year. And this is our net profit for the year. $86,880 plus 18,000 minus 4.5 minus 13,000 plus 450 minus 750 equals to 87,660. So that's your number. So that's your number 2.1. Calculate the adjusted net profit. That's your number 2.1. Therefore, number 2.2, prepare a statement of financial position on 29 February 2016. Okay, based on this information, the following information relates to MG suppliers for the year ended 29 February 2016. The business uses the perpetual inventory system and a constant markup of 50% on cost price. This information relates to income statement, or it's applicable on the statement of profit or loss and other comprehensive income. So here it's our number 2.2. Let me highlight the total, then I will explain. Total 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 and then total here, and then total here. Done. So now we're going back on our 2.2. So in answering the statement of financial position, we're going to look for information inside the trial balance. So it starts with our non-current asset. We're going to look for all the non-current asset and record the closing balance amount. So the first account, or the first item in our trial balance as an asset, is land and building. Land and building 131,000. Nothing happened to land and building, so they open at 131 and close at 131. And here 131. For vehicle, the vehicle that was bought on the transaction, it was 18,000 and depreciated to 4.5. So 18,000 minus 4.5 will remain with 13,500. Then equipment we started with 100,000, and then we bought another one for 10,000, and then the first one depreciated 35,000, and then the second one depreciated 13,000. So in recording this transaction, we're going to take the 100,000, we add the 10,000, we subtract the 35 and the 13, Then we remain with the total. Then investment, we have two investment here. We have fixed deposit, Absa Bank and Nedbank. So we're going to add the two. Investment, the two was added, and then these calculations together they form 239,500. Then we go to our current asset. Under our current asset we have inventory. We have our inventory at the value of 92,500. No inventory was affected on the additional information, so our inventory lies here at 92,500. Then our trade and other receivables. We had a debtors control of 73,500. So I think there's an error in here. 73,500. So 73,500. Then we minus those whom we are writing off. How many are we writing off? We budgeted 3.3 and they told us that the provision must be decreased by 450. So in calculation we're going to say 3.3 minus 450. So 3.3 minus 450 is equal to 2,850. And then 73,500 minus 2,850, that's 76,350. And then we look for another current asset. If you see bank and the amount is on the credit side, this side, it means it is bank overdraft. So bank overdraft goes to current liabilities. So even this one is on the credit side, it's bank overdraft. If it was here, it was going to go under current asset. So our current asset, we only have cash float as 900. Cash float as 900. Then these three, they make up to this answer. I'm not sure since I changed something here, but these three must form this answer. And then your non-current asset and your current asset must be your total asset. Then we go to total equity and liabilities, where we're going to have our owner's equity. Under owner's equity we have three items. We have capital, we have net profit and drawings. Our capital comes from our trial balance. Capital 235,000. Capital 235,000. Our net profit is the one that we calculated, the adjusted net profit, this one. Then our drawings come from the trial balance. Drawings 50,000. So drawings, since the owner is withdrawing money, we subtract the drawings. So this plus this minus this result in 272 owner's equity. Then we go to our non-current liabilities. We only deal with loan, mortgage loan or mortgage bond. So our loan is on the trial balance. Item number 3, mortgage loan 50,000. Let's hear what are they saying. In terms of the loan agreement, FNB will be repaid in 10 equal installments on the 31st December each year. So 50,000 divided by 10, it's 5,000. So they're saying the first installment is payable on the 31st December 2016. So you must check, is this date within your next financial year? Nah. If it's within your next financial year, you must subtract one installment on the capital amount. What I'm saying is this: you must subtract one installment on the capital amount, and then you result in 45,000. Only if the first installment is within your next financial year. If it's not within the next, you don't subtract, you record the capital amount. And then This is equal to your current non-current liabilities. Then your current liabilities formed by three items. Your creditors control 45,000 under your trial balance. Your creditors control 45,000. Then your bank overdraft. This is bank overdraft. Your bank overdraft, your bank is 27,000, 25,000. I meant to say 25,720. Your bank is 25,720 plus 10,000 plus 10,000. Which is this 10,000? They said you bought a laptop for 10,000. No interest was made. How do you buy a laptop if you were owing the bank? Like this one, how do you buy a laptop if you're owing 25,720? I mean to say you owing, you can't buy something cash. Like in here, you bought a new laptop for cash, meaning that you bought it on your account, your bank account, because you don't have money. There it is. And then plus 170, because they charge you interest on overdraft, and they add it to your capital amount, the amount that you're owing on the bank. They add it to your capital amount. So the combination of this form this amount. Then your short-term loan is the one that you subtracted from your loan amount. You put it under current liabilities as 5,000, and then these three make up this amount. So then total of your current liabilities and your non-current liabilities and your owner's equity forms total equity and liabilities. So these two amounts must be the same. Your total assets and your total liabilities must be the same. So go through what I was explaining and see if you could do it yourself. Thank you.